What's up, YouTube? It's Todd Horse Taylor Taste Tracker, and I wanted to do a quick update on the 2020 Small Account Challenge. Now, I know that's not public anymore since I hit 10K, but with the volatility and the market dropping, I'm actually below 10K now. The volatility has increased the margin requirements for my positions, even though they are covered positions. So I'm still doing spreads in here. I do have a couple naked puts here, but they're cash secured. They're very low dollar stocks on EBON, dollar EBON. But let's go ahead and share my screen so you can see what I'm saying. Okay, so here we have EBON is the only short put that I have here that's naked. It's currently negative $13. I have four of those, so that's not a big deal. The rest of these here are spreads. And what that means in theory is that the margin shouldn't go up. But you can see here I had maybe $50 at least in buying power, and it's gone the whole way down, positive 50, the whole way down to negative 84 at one point, I think it was. Yeah, it doesn't matter. Anyway, and now it's at negative 74. Chances are by the end of the day, today after hours, I'll get a margin call notification email from Tastyworks. And what they'll say is that I have 24 or 48 hours, something like that, to rectify the account. I can either do that by closing some of these positions, or I can deposit money. So in this case, I'm going to deposit the $75 if it's needed. There's a good chance, especially if the market has a little bit of a recovery, that will go down to zero. Again, it was higher than this a couple minutes ago. It's come down a little bit, but it does fluctuate as they're adjusting their margin requirements. It's only when the market gets really volatile like this that they'll even adjust the requirements to begin with, which, if you think about it, is actually the worst time to make those adjustments because people are pinned. As you can see, all of my positions are red. That's not actually green. That'll turn red here in a second. You can see the stock is down 4.3%. just today. So we know right away that this will be red. But anyway, all of my positions are red. So in order to cover this, if I didn't have the funds, then I would have to sell out of a losing position that very likely could be a winning position if it were allowed to play out. But that's sort of the downward spiral that the market gets into. So yeah, if we just go over some of the account, now here I have two different positions in Amazon, both for March. So I've got plenty of time and I'm still would be profitable. It's right on the edge. These are not in the money. So yes, if they expired today at this very second, I would get full profit on them. But because of volatility being increased, if we look at VIX, you would see it's up, it's elevated compared to where it should be. Okay, let me actually do that. Okay, so yeah, we can see VIX is increased, although we had a drop yesterday when the shares for GameStop, etc., were not available to be exchanged. We've had a jump up, and even though it's coming down, it's still trending up because until this whole situation calms down, the volatility is going to be increased. What that means is all of our positions, the IV portion that makes up the option contract's price is going to be elevated. Since we're sellers, we don't want increased volatility. We want lower volatility. So all of our positions are naturally going red. That's why now is the best time to enter into a position. Not only are the stock prices down, but these premiums are juiced because of the increased volatility. Realistic volatility, the historic volatility, is never as much as the projected or the anticipated volatility that's coming up. So we want to capitalize that as best we can. And you don't really have to look for which stock has increased volatility. They're all going to be juiced up a little bit more. So let's go to Fiverr. I've got one position there. That one's fine, but I'm down $50. Apple, one position there. That one's fine, but I'm down $50. AMD, one position there. That one's fine, but I'm down $50. I mean, you can see what I'm seeing here. This one again is you can ignore that. But Facebook, one position. Now that one is red, and I'm down $73. But if I expand that, I'm not too far in the money. for this dollar value stock. So my sold leg is 270. It's trading at around 257, 260. And so, yeah, you're talking about less than $15 it needs to move. It moved $7 alone today. So you're looking at 1, 2, 3 days kind of movement, and we would be back out of the money like we want to be for these short positions. Anyway, so the whole point here I want you to see is when volatility increases and the market turns down all positions, even if you think they're not correlated, a lot of these are correlated because I'm mostly in tech, but, Lulu's clothing, BA is obviously Boeing Airplanes, MasterCard, Dollar General. So we've got some of these positions that aren't necessarily highly correlated or shouldn't be they're not in the same sector, but because when the market begins to tank, and we saw this same thing in the COVID crash, we'll see it every time, the market auto correlates to each other. So you can think you're as diversified as you can be, and that's all well and good if the market is in normal conditions, but at this point market is not in normal conditions, and so all the positions are down. And okay, now we're back over 10K. That's nice. And the buying power will fluctuate based on what the margin requirements are for the sold position, not for the long position. Typically on your average day, those aren't going to change. Aren't going to change from week to week or month to month. It's only in this increased amount of fear period that we're in where the brokers want to make sure that they're going to have enough money if things go sideways. So yeah, at this point, I have not received an email from Tastyworks. I do anticipate I'll get one after hours today, and then they'll give me all of Monday at the very least to get things situated. So that would be Monday close, 4 p.m. Eastern time. At the very earliest is when they would require that to be fixed. And a lot of times, if you get a hold of the broker, especially Tastyworks, TD Ameritrade, all the good brokers, you can actually get a hold of their support, and you have a conversation with them. Many times they're willing to extend that time, your deadline of when you would need to. So where people run into issues here with the short squeezes, but when it's done on their account, is this margin exponentially increases day after day after day, and then at some point they can't afford to deposit more funds, and then they have to close out all of their positions, solidifying that loss, cementing it, so they can't be profitable. They're closing at the worst possible moment in their position's life. So the reason we do spreads here is so a situation like this, we're not going to get margin called, or if we do, it's going to be a very small amount, under $100, no biggie, and I've got $10,000 invested. I'm not worried about this account, even though most people would be concerned by all of this red. These are all, they'll be from here up, will turn green as soon as we have one green day on SPY. So I'm not worried about that. I do have a couple positions here that are on the edge, especially DG, but I'm not worried about that. I'm also not worried about blowing up the account in general because I have more held in stock long-term hold ETFs in this account now than what I started off the account with in February of last year, so not even a year ago. I have more held just in long-term stock. So let's go over and I'll show you the stock that I've got at the moment. VIM, VTI, IEIH, ARCQ, Print, and RK. These last three are ARC funds. So yeah, so you can see here I have enough shares in here at this price that it's more than what the account started off with. So in a sense, I'm playing with market money. I don't like to think of it that way, but yeah, definitely not worried about blowing up, even if for some weird reason all of these options became losers. 99% of these are for the March expiration, not for February. So I do have a couple, maybe 3 left on. But yeah, I think I've rambled on long enough here. What I wanted you to see is the losing positions, the buying power decrease, but it fluctuates over time, how they have not emailed me yet. So the second you turn negative does not mean that instant you get margin called and they close all your positions. they will give you time to get it situated. It's almost the exact same process as exercise or assignment. Because the result of getting assigned shares is that you have to compensate for that either by closing your positions or by depositing funds. So it's the same margin call there. It's just that the reason for getting margin called is different, but everything else is the same. All right. If you have any questions, let me know in the comments below. Thanks.